You've probably seen the conventional wisdom, which is all over the place. Roth last. Do not spend it. Roth dollars get taken last. Now, I'm not saying I disagree with that wholesale, but I am saying that I think it's overblown. Today's video is going to walk you through exactly why and when you should take Roth dollars early as part of an overall tax planning strategy and what I'm going to call return on life. So hear me out on this. So most conventional wisdom says early in retirement you should withdraw from taxable accounts, then you're going to take from tax deferred accounts, and then very last you're going to take Roth accounts. In my opinion and in my experience, what happens is the Roth never actually gets spent. Now, if that's your goal, I get it. Maybe you just have a legacy play and you want to leave as much Roth as possible. But my argument here is you should maximize your return on life early in retirement. You did not get to early retirement and save all the money you saved just to skimp as much as possible on expenses and not touch your Roth, even though you actually could, to get more out of those years. I think there's a way to have your cake and eat it too, as they say. That's what this video is actually about. I'm very balanced when it comes to early retirement years and tax planning. I think a lot of people, when they look at tax planning and early retirement, just become way too aggressive at the detriment of their own life. So retirement, you didn't get here and become a disciplined saver to continue delayed gratification in a negative sense. Now, delayed gratification is wonderful, but if it's going to impact your ability to enjoy life, to do things with people that you love, that is not retirement. That's just another job. Basically, your job is working for the tax calculator. You shouldn't do that. So if you're new to the channel, my name is Forrest Dutton. I am the owner of Brightworks Financial Planning. I'm a certified financial planner. I love doing these videos. The goal is to help you retire with confidence. So let's get into today's scenario. Okay, as we kick off today, I just want to give a quick reminder that these videos are not personal advice. They're not personal financial tax investment advice, any other kind of personal advice. Please consult appropriate professionals. So let's get into it. I'm going to start broadly, and then I'm going to get you into the details of this case. So in reality, in your early retirement years, for you that could be 55 to 60. For others, it could be 60 to 65. Some others, it might be 62 to 67. It doesn't matter. I'm going to walk you through a 5-year period, and I'm going to set the stage of what I call the 3-100 plan. Okay? If this is you, then this is something you might want to consider. So what do I mean when I say 3-100 plan? Well, there's basically 3 accounts entering early retirement that would be wonderful to have $100,000 in. Okay, the first one is a Roth IRA. So I'm going to talk about Roth conversions, but I'm simply referring to someone who has saved some Roth along the way, but maybe not as much as they want. So maybe you might have a $3 million traditional IRA, but you still have $100,000 in Roth. I'm going to make the case in this video that there is a case to be made where that money should be spent first in order to make those Roth conversions more effective and more tax efficient. So that's the first 100. The second 100 is cash. If you are entering early retirement, having a substantial amount of cash saved can be really, really helpful in your plan, and I'm going to walk through how. So we have $100,000 in a Roth, we have $100,000 in cash, and again, that's a loose term. That could be literally cash sitting in a checking account. It could be a high yield savings, money market. The point is it's liquid money. The third 100 is the health savings account. Now, if you're retiring at 55 or 60, chances are you've had some years to build up a health savings account. And if you were smart about it, the best way to utilize that account is actually, if you have the cash flow, to pay medical expenses out of pocket and allow that health savings account to be invested and grown. Now, the great thing about that is there's no time limit to when you can reimburse yourself for healthcare expenses while you're covered by that high deductible health plan. So let's just assume over a decade that you have $20,000 in medical expenses. I'm just going to utilize that for this case. So I wanted to walk you through the 3-100 plan so you understand where this might come into play. Now, we're going to utilize a 5-year period, and we're going to try to have our cake and eat it too. I mentioned that phrase at the beginning. Well, what do I mean by that? What I mean is don't miss out on life. Spend what you want to spend. Try to stay in a relatively low income level for the sake of subsidies, and do Roth conversions that you would consider to be substantial enough to meet your plan needs. Now, I realize this isn't going to be the nuclear Roth conversion option. That's people that are going to do multi-$100,000 conversions every year in early retirement. That is not this case, but I do think this could be very helpful. So now we're going to move over to the numbers. I just wanted to set it up first. Okay, let's discuss what it looks like to actually consider utilizing the Roth while being smart. Now, to start off, what I'm going to say here is that remember, this is a 5-year window. So whether it's 55 to 60, whether it's 60 to 65, there are going to be different things that come into play. So I'm going to just land on, at this point, 60 to 65. So what we have is, assuming this is a couple, right? So I'm gonna show this as a tax scenario, planning scenario, as if they are married filing jointly. And what I'm gonna assume is that there's $100,000 in a Roth, $100,000 in a savings account, and $100,000 in a health savings account. Now, what I'm gonna talk about is I'm trying to come up with a way for you to still live your life. And the premise of this video is oftentimes the Roth account just gets pushed, and never gets actually used. And the argument goes like this: Roth accounts are tax-free forever. Why would you want to interrupt tax-free growth? Well, what I'm going to show you is you can still keep the same tax-free growth, and you can actually create more Roth dollars than you would have if it were compounding in the market normally. Okay, so I'm going to defend that in a second. But basically, again, I'm looking for return on life. Is there a way we can still get that tax-free money compounding for us? And can we actually utilize it when we need it? Because when you get to be 85 and 90, a Roth account is not going to just do you much good in terms of return on life. It definitely will help you with taxes, but it's so much better to be able to use it for the purposes you have today. So let's break this down. Let's assume that $100,000 is going to be spent. Remember, we're using the Roth over 5 years. So we're going to take $20,000 out per year. That is not going to show up anywhere on the tax return. That's the beauty of Roth. The next thing I'm going to assume, again, if you've watched any of my videos, I'm a huge fan of taxable brokerage accounts. So I'm assuming there's at least enough taxable brokerage money to live on that in early retirement. So I'm going to assume a $40,000 withdrawal from the taxable account. Now, $40,000 withdrawn from a brokerage account doesn't mean $40,000 of capital gains. For the purpose of this example, we're going to assume that there's $20,000 of taxable gains. Again, everybody's account is different. We've got to make some assumptions. The other thing I'm going to assume is that there are $20,000 of eligible HSA purchases over the years that you're going to reimburse for during these years. Because one thing you need to keep in mind, when it comes to ACA premium subsidies, you cannot take a qualified distribution from an HSA for that. But what you can do is you can reimburse yourself for expenses that you incurred earlier, which is what I'm utilizing here. So I have that $4,000 a year over 5 years. That's $20,000. And I'm also going to assume, again, we've got a large cash account. We've got $100,000, which would be an ideal amount, at least, right? The more is better, but I'm just going to make it a round number at 100 to keep this simple for you. So they're going to take $10,000 over that 5-year period because they don't want to deplete the cash completely. Because when they actually get to the point where they turn Social Security on, or maybe there's some other things that change in their plan, they still want to have what they would consider an emergency reserve of some sort. I'm also going to assume that taxes are going to get paid from this, either from the taxable account or from the cash. Most likely the cash, because that does not flow through to our taxes. So what does this actually mean? So we're actually living on $74,000. That's great. Now here's what's really cool about that. If you structure these distributions this way, if we think about what flows through to the tax return, I'm going to walk you through this. So on the left, this is just showing what are the things that are happening that will be taxable to us. So in this scenario, if you have $100,000 in savings, I'm just assuming you earn somewhere around $3,000 of taxable interest. We're going to have a combination of qualified and ordinary dividends at $4,500. $3,000 of those are qualified, so those are taxed like long-term capital gains. We're going to do a Roth conversion, in this case, of $55,000 per year. So just to bring you up to speed, if we decide we're going to do $55,000 per year for 5 years, That means at the end of 5 years, we're going to have $275,000 that we converted to Roth. Now that might be something beneficial based on your plan that you've already run. You realize that your pre-tax or tax-deferred accounts are going to need converting. So in order to do that, we're taking these income sources and we are converting that money over time. Now the interesting thing about what we've done here is we've kept ourselves in a really good spot in terms of our overall income. So now I'm going to flip to the screen. This is a U.S. average of ACA premium subsidy cutoff. So normally that is 400% of the federal poverty line for your household size. So in this case, we have two people, two adults, age 60, and we make $84,500. I got that straight from that tax planning column that we discussed before. So what will that actually do? So on the right, this is saying without premium tax credits, you would you would pay about $701 per month total, right? So that'll be amongst two people. So that's your total amount per year, monthly, and then we would annualize that for a silver plan on the ACA marketplace. Now, if you got a bronze plan, it would cost you nothing, which is great. So you could choose to utilize that, but here's where the beauty of the HSA comes in. Say you decided that $701 per month. Well, guess what we said before? We were going to utilize $4,000 a year from our HSA to reimburse for previous expenses, but in reality, it can help defray the cost of this. So we just take $4,000 from this. That means our net payment really is just over $4,000. And if you take that on a monthly basis, we're only paying about $367 for healthcare. Not bad. So we're able to do that, plus we're able to actually convert to Roth. Now, again, you may be saying, but wait, we had to spend to convert, right? So I already told you $55,000 for 5 years is $275. So one way I want you to think about this is, what is the return on life and what is the return on the Roth? So let's say that we left that Roth alone. We didn't use that $100,000 at all. This is the argument: leave compounding tax-free growth alone, right? So let's just take $100,000 and let's just say we earn 8% over 5 years. What would our future value be? Well, it would be just under $147,000. Now, I want you to think about this. Remember, if we do $55,000 over 5 years, we're going to get $275,000 in a Roth. Now, you have to subtract what you actually paid to get that return, right? To get that future value. So we would just take 100 off the top because we had to spend 100 of our Roth to get that. We're still at 175. Okay, so if you want to be a real stickler here, you could say, what did we actually pay for the tax? Okay, so let's take 2780 and let's times that by 5. We've got 13.9. So I'm going to go 175 minus 13.9, doing this in real time, $161,100. That's the real value that we actually earned in that Roth relative to what we spent, right? So if we just took that and we said, well, what is that based off of return? Okay, so let's start with 100,000. And again, let's just say that we did that for 5 years. So what is the actual real return? It's about 10%. So again, this is me saying the argument here on don't ever use Roth, let tax-free growth compound forever. I would argue that we just earned a return on our Roth and we actually used it for life. We still lived on the money we wanted to live on. We stayed under our premium subsidy and we got more real dollars, in today's dollars, right, into Roth. So at 5 years, we got 275 versus we started with 100. So in this case, in my opinion, this is well worth considering. Again, it maximizes both what I would call return on life and actually return on the Roth dollars used, because they're not going to do you any good at 85 and 90. Now, this obviously isn't for everyone. I do have a column here called diminished returns. I've run the same scenario if your Roth is higher, and what I'm noticing is when I run this is that your return on that Roth actually does diminish. So if you have 200,000 instead of 100,000 in Roth, this is not as powerful of a strategy, 300,000, etc. And I think that makes intuitive sense. But what I'm trying to tell you is if you have a certain amount in Roth, it doesn't mean you have to just hands off forever. In some cases, this could be a great first 5 years of retirement while meeting some of the goals that you already had in the first place. So hope this was helpful for you. Again, this is just educational, and I hope you found it insightful. Please comment, like, subscribe. That's how I reach more people. And if this is something that you've been pondering and you're just wondering, does this apply to me? These are the kind of things that I do for clients at Brightworks Financial Planning all the time. So again, hope you enjoyed today's video, and I will see you guys next time.